I wanted to share with you a case study about a business owner that transitions their business to their family members or to two active children in the company. So I started with a story where Tom and Cindy, a family I worked with for many years, have a small business. Their earnings are $2 million a year. A competitor, knocked on their door and said, "I'd like to come in and learn about your business and see whether we'd like to make an offer." We're in the acquisition stage, and Tom and Cindy thought it made great sense. They did it. That competitor came back with an offer for $10 million, very clean offer, mostly cash. And Tom and Cindy said no. They just weren't ready at this age to be fully retired. They didn't know their options, and they didn't really have the team. They had a good accountant, but they really didn't have the right legal counsel to help them prepare for a transition at this time. They just weren't ready. They had always thought that they would transition their business to their family or to key people. In this example, I'm going to share with you a case study around how this business could transition to their family members, even though they have in their back pocket a $10 million offer. So oftentimes the structure of transitioning your business to a family member would be, first and foremost, you would recapitalize the stock. You would separate voting shares from non-voting shares, because voting shares allows mom and dad to keep the control close, but to transition the value to the children over some time. The second is you do a formal valuation. So you hire an accounting firm that's going to come in and value your company and tell you what it's going to look like on the street based on their the discipline around doing valuations and the proper IRS world around there. They came back in this valuation and they came back at $6 million, not 10. Interesting, had a $10 million offer, but mom and dad are willing to transition to the kids at a $6 million formal valuation. In addition, when mom and dad sold stock to the two kids, they sold 49.5% to each one of the two kids. They discounted that sale even further by a 25% discount based on the recommendation of their accountant and their estate attorney. And that would be a standard discount for lack of marketability and lack of control, because in theory, these two kids can't control the business. They can't sell their business. Therefore, their stock's worth less than mom and dad's controlling shares. So in this instance, mom and dad sold their business for $4.5 million, $2.25 million for 49.5% of the stock each, and then they financed it over a period of time. The distributions from the company earnings each year, at the end of each year, were distributed to the two kids. The two kids then took it, taxed it, and paid mom and dad back. Mom and dad took that cash and paid tax for the sale when they received the cash. Now, mom and dad were still very active in the business for that 10 years. But remember that mom and dad are taxed at capital gains rates when they receive that money. The growth of the company stock were in the kids' hands for the most part, besides the one share or 1% in the voting stock. The company started a cash balance plan or a retirement plan on top of the 401k and the profit sharing to put money away on a before tax basis out of the company, really for the benefit of all the employees, but it certainly favored Tom and Cindy given their ages and being baby boomers. They updated their buy-sell agreement to say if something happened to mom and dad, what was going to happen to the company stock and that voting share, so there would be no argument between any of the family members associated after Tom and Cindy were to pass. So what was the outcome? Well, for the first 10 years of Tom and Cindy staying active in the business and being a participant in the retirement plan, their pay package supported their lifestyle. They received note payments, which allowed them to take tax and diversify their balance sheet and then grow that 4.5 million tax to capital gains rates over time. They also accumulated a great deal of money in their cash balance plan, in this situation about $4 million in their cash balance plan over that 10-year period of time, which was a great plan for them to complement how the business was to support their capital they needed at age 70 to produce income for their lifestyle thereafter. And then they changed their estate plan so they would provide for inactive children upon the second death, whereas the active children were being rewarded for the activity within the company. So there are no two structures that are alike. This is commonly modeled and you think through putting the best advisors in your team around your family and around that plan. But we know with planning, the sooner you do it, the better. If you'd like more information on planning or putting your forecast or model together, or thinking through some of these different tools and the taxes and trusts that could be involved for you and for your family, please visit us at legacy-online.com. Thank you.